All right, well, after starting May with somewhat of a bang, the S&P is kind of backpedaling for a second day in a row, and our next guest is bracing for a pullback. Joining us now, Frank Fantozzi, CEO of Planned Financial Services. Frank, thanks for being with us. You know, the thing is, though, the way the markets have been acting, it's really hard for people to step out of it right now.
I definitely would agree. The market's been sending very mixed signals, and if history is a little bit of repeating itself, 2010 and 2011 we had a pullback. So the indication is we're lining up for something similar this summer.
So Frank, how are you allocating your investments right now? What direction are you heading?
Well, we're definitely bullish on the S&P. The market overall has met its, at least in our estimation, the 9 to 12% gain already. But we do definitely feel there's a bias towards large cap domestic growth. We feel that that's going to continue to do well for us. We're definitely de-emphasizing Europe. They're sliding into a recession, and we feel that there's not a lot of value there. And we also are still strong from an equity standpoint with emerging markets.
What worries you most about the way this market is reacting these days? Because these big growth companies, we're not seeing any new high flyers come up to lead us out of this.
Well, we've been talking to our clients and analysts, and we're really in a slow growth mode. And unfortunately, that's not the kind of news everyone's very receptive. They want a higher growth rate. They look at the GDP, and they want that to be closer to 2.75 and 3. And right now, we're approaching 2 and 2 1/4, which is not really satisfying the masses.
Frank, do you think the valuations of the equities right now are really reflecting what the economy is telling us and all the data that's coming out, which seems to be spluttering at best? Sputtering along, I guess is what I'm trying to say.
Yeah, that's a good assessment. Well, the valuation, if you look at the earnings to price ratio for the market overall, it's at 13. So from a valuation standpoint, I think the market is correctly priced. Unfortunately, there's a lot of things wavering in the marketplace, which is creating some uncertainty. So certain sectors of the market are looking a little more favorable, like industrials and technology, where other concerns like interest-sensitive notes like treasuries are something that we're trying to de-emphasize for our clients.
You know, I know you're a former Arthur Andersen guy. I was at Ernst & Young, so I got to ask you about taxes. Income tax-free state and local bonds. President Obama thinking about getting rid of that. What does that do to that little market?
Well, definitely it's going to change the flow of funds. From a valuation standpoint, from a historical standpoint, the market prices in income taxes, and it really doesn't change the overall valuation. However, investor behavior, I think, will become a concern only in that, for example, with muni bonds, if they take that off the table, where does the money come from to fund that? And I mean, that's a big source of revenue when you look at your state and local governments. So clearly the flow of investment dollars in 2013 could be impacted if President Obama gets reelected and his tax policy changes come true. Yeah,
we're having a hard enough time getting people to invest in this market. You take away their tax incentives, forget it. Frank Fantozzi, thank you so much for being with us.
Thank you, Tracy. Thank you, Ashley, for having me on your show today.
All right.